Good morning, everyone. It's good to be with you today. My name's Mario Vicari. I'm a director with Kreischer Miller. We're a CPA firm in the Philadelphia area. We serve the tri-state area and serve many private and family-owned businesses, including ESOPs. I'm going to be joined today by Steve Feimster, who's also a director at our firm, and one of my colleagues that works with me in our ESOP practice. Today, Steve and I are going to be covering for about a half an hour the financial implications of an ESOP transaction. I'll be covering some of the higher level transactional elements of that, and Steve is going to be talking about more of the accounting and financial reporting elements. So we're going to get started. As I mentioned, we're going to talk about the characteristics of an ESOP company at a high level. I'll cover some transaction and financial mechanics, and Steve will cover the accounting considerations. So we'll begin. So some of the characteristics of an ESOP company are that an ESOP itself is a qualified employee benefit plan under ERISA. It has to follow strict guidelines of the Department of Labor and the IRS code. It's not dissimilar to a 401k plan that you might have at your company. It's just that the assets that reside in the plan, which is called an employee stock ownership trust or ESOP, the assets that are in there are going to be the company stock as opposed to a bunch of mutual funds and other kinds of things that might be in a 401k plan. The way that the plan works is that the ESOP owns shares beneficially for the employees. The individual employees do not own shares themselves. There's often a lot of confusion about that. There's actually a trustee in charge of the ESOP who represents all of the employees in terms of their share ownerships. The other thing that's unique about an ESOP is that the employees don't contribute to the ESOP. There's no, unlike other kinds of plans like a 401k, it's not a requirement that an employee puts any funds into the plan. So they're a great vehicle in that respect in terms of providing an employee benefit in that the employees don't have to contribute. Transactions with ESOP companies are typically financed. They're leveraged transactions, and we'll talk about that in a little bit, and we'll show some of the transaction characteristics. But the transactions are typically financed with bank debt, and depending on the size of the transaction, there could be seller debt, and it can be a partial or a 100% sale. The profile of an ESOP seller is very important here, because somebody who's trying to achieve a transaction to sell their stock, if they sell to an ESOP, typically that seller, who's going to be typically a private business owner, is trying to solve for multiple motives in terms of their transition of their shares. And when I say multiple motives beyond just the money always matters, but an ESOP seller typically is also doing it for other reasons, like maintaining the legacy of the business, making sure that people's jobs stay intact, and other things, as opposed to just trying to sell for the top dollar. And we'll talk about some of the trade-offs that seller has to think about as an ESOP seller. Another common characteristic in ESOP companies is there's often not a family successor in place for many family businesses. So family businesses who want to preserve the legacy of their family company, if there isn't a family successor around to take over the business, an ESOP provides a good alternative to let the company continue in place, to continue the legacy of what's been there in spite of the fact that there's no family. ESOP companies typically have, a good profile is going to be a company with consistent results, decent growth. An important characteristic here is that a strong executive team needs to be in place. And the reason for that is that ESOP companies, the day after the ESOP transaction happens, really nothing happens about the leadership of the business. It's not like a third-party sale where a new team takes over and the existing team moves on. So it's important that when the transaction is completed, that there is a strong executive team in place and there's succession on the leadership side, so that there's a path forward for the company to continue to operate as an ESOP-owned company after the original owner sells their shares. And then lastly, an owner who is selling to an ESOP has to have a very long time horizon. These are 100% leveraged transactions. There's no third-party capital coming to these transactions other than debt. And so there has to be time allowed for the company to de-lever itself. And so an owner who is choosing the ESOP route has to have a fairly long time horizon for their exit. So we're going to talk a little bit now about the profile of a transaction and the trade-offs an owner has to make if you're thinking about an ESOP. The first is that, as I said earlier, it can be a 100% sale or the sale of a minority interest. And each of those have different structural elements. One thing that will happen almost in either case is that the valuation of an ESOP transaction is going to be lower than the price for a third-party transaction. And therein lies the first trade-off. Also, if you're going to do a minority ESOP transaction, there's going to be further discounts that are going to apply to that value because it's a minority stake and doesn't have control. So that's the first trade-off an owner makes in doing an ESOP. So on one hand, they get the advantage of being able to include their employees, continue the business with the same set of managers, but they're sacrificing some of the purchase price because the valuation will typically be lower than if a third party came to the table with cash. Obviously, that means then that there's less upfront cash to the seller in an ESOP transaction. That owner that sells their shares is going to get some money up front based on the amount of bank debt that can be raised as part of the transaction, but they're not going to get all cash like they would in a third-party sale. So again, the owner's making some trade-offs here to do the ESOP because they are wanting to satisfy other things like take care of their employees and leave the business intact. 100% sale is usually financed part via bank debt and seller financing. Now, this is a very important point that most people don't realize about ESOP transactions, is that it's basically a 100% leveraged buyout. If you did a 100% transaction, you're going to leverage 100% of the value of the company with some form of debt. Again, the first part is going to be bank debt, and then the balance will be some kind of seller-held note. One of the reasons that these leverage buyouts can work at 100% leverage, which is a lot, is that an ESOP has special tax benefits, particularly if you're an S Corp, and that allows for the debt basically to be repaid with 100% of the earnings of the business, because an S Corp owned ESOP is exempt from federal and most state income taxes. Pennsylvania and New Jersey would be in that category. So if an ESOP is owned, ESOP stock in the company is an S Corp, that earning stream never hits the taxes annually, so that 100% of the earnings are available to repay debt. So that ESOP S Corporation tax benefit allows the leverage to be reduced quicker. And then lastly, one of the other trade-offs, at least in the other direction I mentioned this prior, is that the ESOP transaction conveys more control to the seller. So if you have a seller who wants to transition their stock, selling to an ESOP, the next day after the sale, nothing else changes. If that seller wants to continue to be the CEO or chairman of the company, they can continue to do that. They leave their management staff in place. So that's often another reason why people like ESOPs, because they want to slowly retire from the company, as opposed to sort of a cliff situation in case of a sale to a third party. So there's two parts I'm going to cover here with some illustrations in the next few minutes. The first is the upfront transaction, which is how the company establishes the ESOP trust. The ESOP trust purchases the stock, and then how the financing is provided. And we're going to show an illustration of that. And then the ongoing operation of the ESOP as to how contributions get paid into the ESOP, and then how the ESOP repays the debt that it gets from buying the debt that it has to repay from purchasing the stock. So we're going to now go through a few illustrations to show those things. So this is the initial C Corp transaction. There's a little bit of a different structure in an S Corp that I'll explain in a moment. But the first step is that a bank comes into the picture and provides some financing to the company. And that's going to vary based on the case and how much other leverage the company has, but the bank is going to do a normal credit assessment of the company, is going to provide capital to fund the transaction. Step two, the company then takes the funds that it received from the bank and it lends it to the ESOP. This second transaction, this note that goes back between the ESOP and the company is called an inside loan. That's the term of art that you'll hear. This is the outside loan between the bank and the company. So there's two loans here, and the company has a loan on each side, some coming in, some going out, that sort of cancel out. So ultimately, if you look through it, the ESOP owes to the company the money, and the company owes the bank, and you'll see how that money circulates later. The third part of the transaction then is the ESOP then uses those shares that it purchased, or the cash that it got from the company in terms of its loan, and then it gives that cash to the shareholders in exchange for the stock. The reason for the structure being this way, in that the shareholders and the ESOP are exchanging money, is that this is for a potential 1042 transaction, which is specific to a C corporation. We're not going to go through the details of how to do that. You just would want to make a note today that if the company is if the shares of the company are a C corporation and the stock is sold, that the seller has the opportunity to defer their capital gain. That's probably a whole webinar. We can give it another time on how that works. But for now, just make note that if it's an initial C corporation, this step is very important, that the shareholders have to be purchasing the stock from the ESOP, or the ESOP is purchasing the stock directly from the shareholders. So this is an S Corp transaction structure, which is very similar, except it alters in one respect, that the company redeems. So we'll go through this quickly. Again, cash comes from a bank or a lender to the company to finance the deal. At this point, the second step is that the company then redeems the stock directly from the shareholders. So the shareholders get their money from the company at this point. By the way, the reason why the bank does not lend to the ESOP is that the ESOP does not have any collateral in it. So the bank is typically going to lend money to the company because it's going to use the company's assets as collateral. But step two in an S Corp transaction is that the company redeems its stock, and then step three, the company then issues the stock to the ESOP. So again, two different ways to get to the same place. The first example is driven more by specific tax advantages in a 1042 transaction. If the initial sale is from an S corporation, that tax deferral is not available. So this is the structure that you would typically see. Okay, lastly, for my section, before I turn it over to Steve, I'm going to cover how the funds flow once the ESOP is launched and the debt's in place. So the first thing that happens is the company is going to make contributions to the ESOP. So each year the company is going to, based on ERISA rules, make contributions into the ESOP based on the employee census. The other thing that's going to happen is that the ESOP will be a shareholder of the company, so it can also receive dividends if it's a C Corp, or distributions as an S. So funds flow into the ESOP, and remember that that inside loan exists. So the ESOP then turns around and gives that money back to the company in the form of a loan repayment. That's called that inside loan that I spoke about earlier. So the money comes back to the company. So step one, the money goes to the ESOP. Step two, it comes back. And then step three, then the company uses those funds to repay the bank and or if there's shareholder debt. Now, this is, as you can see, very circuitous. The money is going in and out of the ESOP and the company because there's debt on both sides. Essentially, what's happening, though, is that if you really look through this, all of these contributions that are going in and dividends that are coming back as loan repayments, you're essentially getting a tax deduction for the loan repayments, which you cannot do in another structure. Another element of what's important here with the loan repayments is this is how, within the ESOP, how shares then get allocated to the employees. So the shares, as I mentioned on the earlier slide, are pledged as collateral for the inside loan. And at the start of the transaction, the ESOP shares are fully encumbered because there's debt against them. So the value of the ESOP at that point is really zero because there's shares in there, but they're fully encumbered by all of the debt that was done for the transaction. So what happens is each year, as money changes hand and the ESOP repays the company this inside loan, what happens is that then frees up equity in those ESOP shares, and then that's what gets allocated each year. So each year, as this loan balance is repaid on this inside loan, those available ESOP shares that get freed up because they're now equity in them they get allocated based on all the employees in the company, based on their census and their relativity of their W-2 compensation within ERISA limits. And so over time, what happens to the individuals, as I said, they don't pay any money for their ESOP shares, but what happens is the individuals get equity in their ESOP shares as the loan gets repaid. So as the company contributes money, the ESOP pays its loan off to the company, the individual participant accounts go up in value by the reduction in that debt. And then also, if the ESOP works and it encourages employee behavior and the company does well, then what happens is that also increases the value of the company's stock, which then goes to the benefit of the plan participants in the ESOP. That's the end of my slides. I'm going to turn this over to Steve, and he's going to talk about some of the accounting and financial reporting considerations.
Thanks, Mario. So my goal here is to kind of go through somewhat high level the financial and accounting impacts, because as you'll see in the next few slides, there can be a pretty dramatic impact both on your balance sheet and your income statement. And every ESOP is going to be structured a little bit differently. Mario kind of went over like high level some of the structure of typically what we see, but since they're always going to be a little bit different, I'm going to keep it somewhat general here. So starting with the balance sheet and thinking back to those visuals there with how the ESOP transaction is initially set up, the company is kind of like a middleman because they're taking out the bank debt or also the seller note, and then they're also going to have this receivable, this inside loan from the ESOP itself. So intuitively, you would think that on a balance sheet perspective, this would just be kind of a big gross up on the balance sheet. You'd have the asset and the liability, but it's actually not. With ESOP accounting, that inside loan is not shown as an asset, it's actually shown as contra equity. So the result here is actually a double hit, because now you have your liabilities in the form of bank debt and your seller note, and now your equity is now reduced by usually that same amount. So you can kind of think of it actually as a treasury stock transaction. Instead of the note receivable being booked, it's actually going to be the contra equity is going to represent the number of shares that the ESOP purchased, multiplied by the share value that they acquired those shares at. And I'll go through kind of a simplistic example of this in a minute. Now on the income statement, I'll say the quirkiest part of this is going to be ESOP compensation. So you think back to that repayment visual that Mario was just running through. Company is making contributions to the ESOP, but then those funds are coming right back to the company. So in terms of cash, it's really zero cash contribution. So how do you book compensation if the money's coming right back? Well, the answer is you actually book it at the fair value of the shares that are getting released. So as those contributions are getting made, those shares are now coming out of collateral, and now they're being able to be allocated to those participants, and those shares are going to get valued based on your year-end valuation, which comes into play your annual valuation, where you make that final adjustment. The next potential quirky aspect of ESOP compensation is the potential for dividends and distributions running through the P&L. So thinking back to your share pool, and in day one, they're all unallocated, meaning that they're not yet allocated participants because they're all kind of tied up in that inside loan collateral. So any dividends and distributions that the company makes on the unallocated shares, instead of running through equity, that's actually going to run through ESOP compensation, which is very different from what you've typically seen. Obviously, dividends and distributions are typically run through equity, and this could have a potential big impact on your income statement. For example, if you have an S corp where you have only a partial ESOP, so let's say a 60% owner and a 40% ESOP, and you have to make tax distributions to your owner of, say, $600,000 in this scenario. Well, you also have to make pro rata distributions to the ESOP of $400,000. And if they're all unallocated shares, that's now $400,000 in distributions that are going to be running through your income statement. So things to keep in mind, of potential impacts down the road. And then my last bullet here on the income statement is something that we do for pretty much all of our ESOP clients, not a required presentation, but we find that it helps to segregate ESOP compensation on the face of the income statement because then it really kind of splits it out and allows the users of the financials to clearly see, all right, of what's making up net income here, and how much of that is ESOP compensation, which is potentially, market value adjustments or distributions that normally for a non-ESOP company wouldn't be a part of the P&L. And then lastly, cash flow statement. Not going to really go through an example here in terms of cash flow, because again, thinking back on that visual, ultimately the cash is zero in this scenario if all the money's coming back to repay the inside loan. So in terms of the cash flow statement, there's not a huge impact. There's just going to be more of those non-cash adjustments in the cash flow statement, again, relating to your fair market value of shares released adjustment. Okay, so I'm going to run through a quick scenario, and it's going to be somewhat simplistic here, but hopefully you can use it as a resource down the road as well when you go back to these slides. So let's assume a 100% transaction, a 100% sale to the ESOP, the value of which was $7 million. The ESOP is acquiring all 100 shares outstanding for a per share value of $70,000, and they funded that through a combination of a bank loan of $5 million and a seller note of $2 million. And then now they also have an inside loan, which is ordinarily going to mirror that outside funding. So that's also going to be $7 million. That inside loan typically has an interest component. So here I'm saying 2%, and the repayment on that inside loan is going to be 10 years. And I have the annual principal and interest method, the debt service of $771,000. So ordinarily, in calculating the amount of shares that are going to get released each year, you're going to use the total payment and not just the principal version. So running through year one here, company makes a contribution to the ESOP of $771,000, because the company has to make a contribution in an amount equal for the ESOP to repay the loan, since day one the ESOP really has no assets. So they contribute $771,000. You're going to record your ESOP compensation by that amount. Now that cash is coming right back to the company for the inside loan repayment, and that's when your contra equity account, that unearned ESOP shares, is going to get reduced, because those shares are now getting pulled out of collateral and are going to be able to be allocated to participants. So in this scenario, we've paid essentially 1/10 of the total debt service on the inside loan. So we're going to release 10% of our shares. So 10 shares get released in year one. And let's, for the sake of this example, assume that the value went up and now the per share value is $105,000. So what is our ESOP compensation at the end of year one? It's not going to be $771,000, because that cash came right back. It's going to be the value of the shares that were actually allocated to participants. So, and for simplicity purposes, we're going to say it's $1,050,000 here. Technically, you would want to take the beginning and ending year share value, but again, we're going to keep it simple for the example. So ESOP compensation has to increase by $278,000, and the other side of that entry is going to go to APIC. So I'm going to run through a balance sheet and an income statement example now, so you can kind of visualize it. So pre-ESOP, think of a typical balance sheet that you would see: assets, liabilities, and we have a debt to equity ratio here of 1:1. Now let's go day one of an ESOP transaction. Assets are unchanged, because remember, the inside loan is not going to be shown as an asset on the balance sheet. On the liabilities now, we have ESOP debt of $7 million, and that's going to be the combination of the bank loan of $5 million and the subordinated seller note of $2 million. And now that inside loan is now contra equity. So now that is causing a huge drop in your equity of your balance sheet. And that's also causing your debt to equity ratio to plummet. Now it's -6. So it's important here to essentially kind of normalize it here. And to normalize it, you wouldn't back out the ESOP, the bank debt, and the seller note, because those are true liabilities of the company. But to normalize it, you would remove the unearned ESOP shares from your equity, and now you're looking at debt to equity of 2.4, which again is an increase from pre-ESOP, because now you're taking on this the bank and the seller notes, but a little bit more normalized than the -6. And it's important to understand the mechanics here, not just for management, but also the users of your financial statements. Namely, lenders, you want to be able to convey what's going on, especially if the lender is not too familiar with ESOP transactions, to be able to communicate, how to interpret this post ESOP balance sheet. Now, income statement example, there's a little bit more pieces going on here. So I'll start here on the left side. Think of your typical income statement. So in this scenario, we're going to assume a C Corp pre-ESOP. So we have income from operations of 5, other expenses of 2, and income tax expense of 1.5 million. So we have net income of 1.5. Now with the ESOP, we have the addition of the ESOP compensation of the $1,050,000. And this is going to be, so as I said, we typically show this as a separate line, so it's easy to pick out in the P&L. But it is important to note that it is going to be included in income from operations. So it's not something that you can show below the line because it is still a form of compensation for your employees. Now we also have interest expense now that we have debt on the books. But on the flip side, assuming we converted to an S Corp in this scenario, now we no longer have any income tax expense. So looking at the side by side, in this scenario, net income actually increased because your interest expense and your ESOP compensation was actually less than your pre-ESOP income tax expense. But your EBITDA went down, and that's because of the ESOP compensation. So typically the normalizing function that we see here in terms of the income statement is a variation of EBITDA, which is EBITDA-E, which adds back the ESOP compensation, which you'll see when that's added back. Now we're comparative with the pre-ESOP income statement. And that's a formula that we typically see with our ESOP clients, especially when it comes to financial covenants and debt service coverage ratios. Typically that ESOP compensation is going to be an add back in that calculation. So if you're considering an ESOP transaction, I think that's one of my takeaways here is to make sure that ESOP compensation is added back in any kind of future financial covenants. Because as I mentioned earlier, this ESOP compensation number could swing pretty drastically. It's driven by the value of the company. So if you have a large spike in a current year, this value is going to go up. And also if you have to make pro rata distributions and things like that, again, that's all going to kind of flow through here. So it's important to make sure that that's an add back, and it's also important to be able to explain ESOP compensation to the users of your financial statements. So that was the accounting implications kind of in a nutshell. Going back through the presentation, 3 kind of major takeaways here is the structure of how ESOPs work, the different kind of structures that you can have, but also all the tax benefits and really what a typical ESOP company and seller look like. Understanding the unique accounting implications, both from a balance sheet perspective and also from an income statement once you do an ESOP transaction. And then lastly, just the importance of being able to interpret your financial statements post ESOP and somewhat normalize them and explain them to the users of your financial statements. So that concludes this session. Mario and I are going to be available after this session to answer any questions that you may have on ESOPs, and we're looking forward to it. Thank you.